Welcome to Mastering Implied Volatility, what every options trader needs to know. Dare I say this is one of the most important and best options trading videos that I've created, as this video is going to be packed with simple explanations and tons of data visualizations to help you fully understand implied volatility and what you want implied volatility to do when you are trading the most popular options trading strategies. I promise you this video is going to be a game changer for you, especially if you are new to options trading, so let's get started. So first and foremost, what is implied volatility? I think it helps to break these two words down into alternative words to better understand what they mean. So instead of implied, we could think of hinted or suggested, and instead of volatility, we can think of price movements or price fluctuations. And if we think of implied volatility as hinted price movements or suggested price fluctuations, I think it becomes a much more approachable term. So let's understand exactly what that means. I like to think of implied volatility as the expected or hinted magnitude of a stock's price changes in the future as implied by the stock's option prices. So really, implied volatility is just looking at option prices on a particular stock, and from the option prices, the options are implying certain behavior or certain anticipated behavior of the stock price in the future. For example, if we look at SPY, which is the S&P 500 ETF, and we see that SPY has a current price of $447. If we look at a 40-day 450 strike call option on SPY, we can see that the price as of this recording was $8. If we go to Nvidia, which had the same exact closing stock price as of this recording, and we look at that same 40-day 450 strike call option, we can see that Nvidia's call option is trading for $34.50. Now, when I pulled the implied volatility numbers from SPY and Nvidia, I saw that SPY's implied volatility was 17%, and Nvidia's implied volatility was 60%. Now, the big lesson here is just to see that from the way more expensive Nvidia option price, the implied volatility of Nvidia is much higher. And what this means very simply is that Nvidia's way higher option prices are suggesting to us that Nvidia's stock price is way more volatile than the shares of SPY. What I did was I went back 5 years and I made a histogram of the daily percentage changes in SPY and Nvidia. As we can see, the green bars represent SPY's daily price changes, or the frequency of the daily price changes. And we can see that the daily price changes of SPY are much tighter, much lower than the daily price changes observed in Nvidia. So Nvidia's stock volatility is much higher than SPY's stock volatility, which results in more expensive Nvidia option prices and therefore higher implied volatility, aka higher option prices on Nvidia as compared to SPY. If you're enjoying this video and you want more in-depth content just like this, check out my free 100-page Options Trading for Beginners PDF that's packed with in-depth explanations and awesome data visualizations to help teach you the essential options trading concepts and strategies quickly. I've worked countless hours over the past few days to put value into this, and I promise you it's a game changer. So if you're interested, be sure to check the link down in the description below to grab your copy for free. Let's get to the fun stuff now and learn why implied volatility is so important. Well, implied volatility is so important because changes in expected stock volatility will have an impact on option prices and therefore trade profitability or performance. What I want to do now is look at option strategy, profits and losses versus changes in implied volatility. So let's explore how popular option strategies perform when implied volatility changes, so we know exactly what we want implied volatility to do when we trade each respective option strategy. In the following graphs, we are going to be looking at simulated option strategy profits and losses based on the following inputs. The entry implied volatility for all of these scenarios is 20%. Then we're going to change the implied volatility to 10%, meaning a 10% drop in implied volatility from the time of entry, and also look at 30% IV, which would represent a 10% increase in the implied volatility from the time of entry. The days to expiration for all the simulations is 60 days, and we're going to hold that constant, and we're going to look at various stock prices. So essentially, we're just going to look at the profits and losses of popular option strategies based on implied volatility changes alone, assuming no passage of time and at various stock prices. This first chart is just buy and call options, aka long call options, and we are looking at a 200 strike call option with an entry implied volatility of 20%. As we can see, when buying call options, we want implied volatility to increase, meaning that if we buy the call at 20% implied volatility, if implied volatility increases after buying call options, we will have better profitability or slightly lower losses as compared to no change in implied volatility, and especially compared to a decrease in implied volatility. Let's move on to buying puts, aka long puts. In this simulation, we're looking at buying a 200 strike put, again with 60 days to expiration, and an entry implied volatility of 20%. As we can see, just like buying calls, when buying put options, we also want implied volatility to increase because, as we can see in this gold line here, the profitability is better than if implied volatility stays the same or decreases. So when we buy call options or put options, we are always better off if implied volatility increases, aka there is more expected stock price movement or volatility going forward, because that will lift option prices. And since we own a call or own a put option, inflation of option prices is going to help us regardless of where the stock price is. In this simulation, we're looking at the short strangle, which is a popular market neutral option selling strategy consisting of shorting a put option and shorting a call option that are both out of the money, but it is a very high risk strategy, as we can see in this P&L graphic. But here we are assuming the stock price is at $200 at entry and 20% implied volatility. As we can see, when shorting strangles, we want implied volatility to fall regardless of the stock price movement. As we can see here, if we look at this dashed green line and go to the white line, this represents a 10% decrease in implied volatility after shorting this strangle. And we can see that if implied volatility falls, we will have better profitability at all stock prices. And conversely, if we have an increase in implied volatility, that is going to negatively impact the profitability of our short strangle. So when shorting strangles, we want implied volatility to fall regardless of the stock price movement. And in this simulation, we are looking at the short straddle, where we are selling the 200 put and the 200 call. Just like shorting strangles, when we are shorting straddles, we also want implied volatility to fall regardless of the stock price movement, because a decrease in implied volatility means that the option prices have shrunk or deflated because the market is expecting less volatility from the stock going forward. And if we short straddles and the stock price becomes less volatile and the market expects less volatility going forward, that is going to lead to a contraction or decrease in the option prices. And if we're shorting options, we want the option prices to shrink. And if implied volatility falls, that is exactly what is happening. Now I want to talk about understanding IV changes and option strategy performance. So we just walked through a bunch of popular option strategies and looked at what happens to the strategy's performance when implied volatility increases or decreases. Now I want to talk about how to interpret that and understand it logically. So what does a decrease in implied volatility actually mean? Well, it means there's less uncertainty about the stock's future price movements, and this means that there's a higher probability that the stock will be around its current price in the future. So if implied volatility collapses, that means the option prices have collapsed, and since the option prices are suggesting to us what the stock's future volatility could be, if the option prices collapse, that means the market is suggesting to us that they expect less stock volatility in the future, and less stock volatility in the future means there's a higher probability that the stock price will end closer to its current price as compared to when implied volatility was higher. So let's go back to the short straddle graphic and explain exactly what I mean by the implied volatility decreasing and there being less uncertainty about the stock's future prices. If implied volatility falls, the options are telling us that the stock price has a higher probability of being closer to its current price in the future compared to higher implied volatility. So if I'm short the 200 straddle and implied volatility collapses with the stock price at 200, then the options are saying that there's a higher probability that the stock price will be around $200 in the future. And since the option prices fell and are suggesting less volatility, then the short straddle will profit since I am short a call option and put option at the same strike price. In the case of buying a call spread or having a bull call spread, if implied volatility falls, again, the options are telling us that the stock price has a higher probability of being closer to its current price in the future as compared to when implied volatility was higher. So if I own a call spread that's fully in the money, that means my spread has a higher probability of expiring fully in the money, and the spread price will therefore increase and my position will gain value. However, if the spread is out of the money and implied volatility falls, that means that the probability of my spread expiring worthless will actually increase, and therefore the spread price will fall and my position will lose value. Now, what does an increase in implied volatility mean? An increase in implied volatility means there's more uncertainty about the stock's future price changes. So if we have an increase in implied volatility, that means option prices have expanded, and the option price expansion is suggesting to us that the market has more uncertainty about where that stock price is going to be in the future. So that means that there's a lower probability that the stock price will be around its current price in the future. For example, if we go to the short iron condor graph, if implied volatility increases, once again, that means the options are telling us that the stock price has a lower probability of being close to its price in the future compared to when implied volatility was lower. So if I'm short an iron condor and IV surges with the stock price in between my short strikes, then the probability of the stock price staying between the short strikes is now lower. And that means the probability of this short iron condor position achieving the maximum profit potential is lower. And therefore the iron condor position will increase in price and I will lose money as the short trader. All right, let's move on to a bonus section, which is implied volatility behavior on meme stocks such as GME or GameStop. So this is a little bonus section I wanted to throw in there because I think it's kind of fun, but it is also educational as well if you are an options trader who is into the YOLO trading and trading options on meme stocks. So let's say a trader wanted to short the GME pump in early 2023 by purchasing put options. And let's say they timed the trade perfectly, purchasing slightly out of the money puts at the top of the rally on March 22nd, 2023. As we can see here, if we're looking at the GME stock price versus the put option that has a 20 strike price expiring in May 2023, we can see that even though the stock price fell towards and through the put strike price of $20, the put option still fell in value. And this is a perfect example of how you can be right directionally on an option purchase, yet you can still lose money because implied volatility overwhelmed and drove the trade performance. Let's look at what implied volatility did over this exact same period. If we change this lower half of the graph from the puts price to implied volatility, we can see that the stock price fell and implied volatility, which is measuring option prices, actually collapsed. So the collapse in implied volatility is what caused the put purchase to lose money even though the stock price was declining, and we would think that buying put options and seeing a big drop in the stock price would lose money. So even though the stock price was falling towards and ultimately through the put strike price of $20, implied volatility went from 100% down to about 55%, which is a massive decrease, and ultimately led to a losing put purchase trade in GME. And this is because implied volatility on meme stocks is typically positively correlated with the stock price. This means that if the stock price goes up, so will implied volatility or the amount of premium in the option prices. So in this highlighted region, GME stock price went from $18 to $27, but we saw implied volatility in GME go from 60% to over 100%, and this was the mean 30-day implied volatility as provided by a website called alphaquery.com. Since implied volatility typically surges on these meme stocks, if you are buying call options on those meme stocks and the stock price surges and implied volatility explodes because traders are buying the options in a frenzy, then you can see an explosion in the profitability of your call option purchase. So imagine if the stock price is at 100 and implied volatility is at 50%, and the stock price goes up to 120 and implied volatility goes up to 100%. Based on this simulation, the call price would go from a little over $10 to almost $60, which would be almost a 6x in the value of the call option. So just understand that when traders are buying options on meme stocks, you can have super profitability because of the increase in the stock price combined with the increase in implied volatility when the stock price goes to the moon. If you enjoyed this video and you want a copy of all the slides in PDF format, plus an additional 100 slides on options trading for beginners, then check the link down in the description below where you can download that PDF for free. And if you found this video valuable, I would greatly appreciate it if you left me a comment down below and also shared this video with your options trading friends. My name is Chris from Project Finance, and I will see you all in the next video.